Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 19th, 2025, and we are taking a deep dive into the BoE currency pair, also known as cable. We'll start by examining the crucial fundamental news driving the market sentiment before moving into a thorough technical analysis of the charts. First, let's talk about the macroeconomic environment, which is heavily influencing this pair. The dominant theme right now is the significant divergence in monetary policy between the U.S. Federal Reserve and the Bank of England. Analysts are widely forecasting a stronger U.S. dollar heading into 2026. This is largely because the Fed is maintaining a cautious, if not hawkish, stance to manage strong U.S. economic growth and inflation. In stark contrast, the Bank of England has adopted a much more dovish tone due to the fragile state of the UK economy. The market is now pricing in the possibility of up to 3/4-point rate cuts by the BoE in the next year. This policy divergence creates a powerful fundamental reason to be bearish on BoE, as lower interest rates typically decrease the value of a currency. Adding to the pressure on the pound, recent UK employment data has been disappointing, fueling speculation that the BoE will have to act sooner rather than later. Furthermore, concerns about the UK's fiscal outlook ahead of the November budget are acting as another headwind. On the other side of the Atlantic, the US dollar is benefiting from a risk-off sentiment in the broader markets, fueled by geopolitical tensions and renewed US-China trade uncertainties. This flight to safety naturally boosts demand for the US dollar as a safe haven asset. So, with that fundamental picture in mind, let's turn to the charts and see how this narrative is reflected in the price action. We are starting here on the daily chart to get a sense of the bigger picture. As you can see, since peaking out in June and July of this year, BoE has been in a clear and sustained downtrend. The price reached highs above 1.37, but has since carved out a series of lower highs and lower lows. We can see a significant leg down in early September, where the price fell sharply from above 1.35. Another aggressive sell-off occurred in early October, which took the price from the 1.34 area down to a new low for the move. Specifically, on October 9th, the pair bottomed out around the 1.3278 level. This level now acts as a critical medium-term support that everyone is watching. Following that low, we saw a corrective bounce over the past week. The price rallied back up, culminating in a high of 1.3472 on October 17th. However, this is where the story gets interesting for the bears. The most recent daily candle from Friday, October 17th, shows a clear rejection from that 1.3472 resistance level. The pair closed much lower at 1.3420, indicating that sellers stepped in aggressively at those higher prices. This price action suggests that the recent bounce may have just been a short-term correction in a continuing downtrend. The key resistance to watch now is that 1.3472 high. Above that, we have the psychological 1.3500 level, which will likely present a major hurdle for any bullish attempts. On the downside, initial support lies around the 1.3400 mark, near where the market is currently trading. Below that, the next significant support zone is around 1.3300, and of course, the major low at 1.3278. Now, let's zoom in on the hourly chart to get a better look at this recent reversal. We're filtering the chart to show the price action from October 15th through the 17th. Here we can clearly see the rally that took place on the 15th and 16th, with a series of strong bullish candles. The momentum carried the price all the way up to that 1.3472 peak early on the 17th. But look what happened immediately after hitting that high. We see a sharp reversal, with several consecutive bearish hourly candles erasing a significant portion of the gains. The price then consolidated sideways, finding temporary support around the 1.342 level. This consolidation after a sharp drop can often be a continuation pattern, suggesting that the next move is more likely to be to the downside. For day traders, this reversal from a key resistance level on the daily chart provided a classic short-selling opportunity. The failure to hold above 1.345 was a clear sign that sellers were taking control in the short term. To get an even more granular view, let's switch to the 15-minute chart and focus just on the price action from October 17th. Here you can see the battle between buyers and sellers in high definition. After the initial peak, the price broke down and established a pattern of lower highs and lower lows throughout the rest of the trading day. Each attempt to rally was met with selling pressure, confirming the intraday shift in momentum from bullish to bearish. This type of price action on a lower time frame reinforces the rejection we saw at the resistance level on the daily chart. It shows that the bearish sentiment is present across multiple time frames, which strengthens the overall bearish case. So, let's pull back to the daily chart and summarize what we've learned. The fundamental picture is decidedly bearish for GBPUSD due to diverging central bank policies. The long-term technical trend is also bearish. And the short-term price action shows a rejection at a key resistance level. Let's recap the critical price levels to watch. Immediate resistance is at 1.3472, the high from last week. A break above this could see a move towards the major psychological resistance at 1.3500. To the downside, immediate support is at 1.3420. A break below this level would open the door to retest the 1.3300 support zone. The most critical support remains the October low at 1.3278. Now for some unbiased predictions. The bearish scenario seems most likely, and I would assign it a 70% probability. This would involve a break of 1.3420, leading to a test of the 1.3300 to 1.3278 support area in the coming week or two. This view would be reinforced by strong U.S. inflation data or any further dovish commentary from the Bank of England. A more extreme bearish case, as some analysts predict for 2026, would see a break of these lows and a move towards 1.29 or even lower over the long term. The bullish case, which I would give a 30% probability, requires buyers to step in and push the price decisively back above the 1.3472 resistance. To truly negate the bearish pressure, we would need to see a sustained close above the 1.3500 level. This scenario would likely need a catalyst, such as surprisingly weak U.S. economic data or a sudden hawkish shift from the BoE. So, the key things to watch for in the upcoming week are the inflation figures from both the UK and the US, as these will be critical in shaping the Fed and BoE's next moves. Keep a close eye on those key price levels, as they will tell you who is in control of the market. Thank you for watching this analysis on Explain the Charts. Please remember, this is for informational purposes only and is not financial advice. Trading involves significant risk, and you should always conduct your own research and consult with a financial professional before making any investment decisions. If you found this video helpful, please hit the like button, subscribe to the channel, and let us know your thoughts on GBPUSD in the comments below.